our first learning objective is knowledge of multi-factor asset pricing models. And what you notice, of course, over here, guys, what's interesting, which I find very interesting, there's not a whole batch on CAPM over here. CAPM, of course, we know is not a multi-factor model, but is a single-factor model. That factor, of course, being that of the market, but not handled overly much over here. Okay, away we go. Let's go. Okay, so we're going to talk about multi-factor asset pricing models. Okay, we talk a little bit about marginal utility in the CAPM. Talk about good times and bad times, particularly more on the bad times. We focus on expected utility and anomalies. Major categories of factors, the three major categories, we'll talk about those. Okay, empirical, okay, versus theoretical models, how those were, and remember, guys, there's not a whole batch of difference. We've already seen theoretical and empirical in the previous chapters. We'll just bring those discussions back in again. Try not to divorce concepts from different chapters. Let's try and look at the whole, at least each particular topic as one holistic picture, that we come out with a bit of a complete picture of what we're looking at. Okay, fundamentals of empirical models, and then we'll talk about, are factors, okay, in fact tradable. Okay, we start off over here, guys. We talk about multi-factor asset pricing, and all that we're doing in multi-factor asset pricing is relatively simple, guys. Is I'm trying to identify what is the return, or the required return, the expected return is probably the better term that we're looking for. What is the expected return on this particular asset? What is the expected return on this particular investment that I'm looking at? Okay, CAPM only looked at one factor. And what was that one factor? That one factor was the factor called the market. A lot of guys tell me that the single factor model called CAPM has got one factor, and that factor is called beta, or some people call it beta. Depends where you're from. Makes no difference. Okay, they say that is the factor. Beta is not a factor. Beta is a sensitivity to the factor. The CAPM factor is that of the market. Beta measures how sensitive our particular asset, investment, or security is relative to the market. Okay, so just be very mindful of that. Just a little bit of an error sometimes that does creep in, but of course not for you guys. This is the clever class. Okay. Multi-factor models, as opposed to CAPM, okay, focus on many more factors, as opposed to just a single factor, which we call the market factor. CAPM focuses much more on other factors as well, not just the one factor, which is the CAPM, which is that of the market. Okay, we move on a little bit, talking about multi-factor models, and the model is simple. Okay, let's look at the model very briefly, and this is the model for everything. We'll change the factors as we go through, but the model itself is fairly straightforward. Let's have a look. So the expected return is equal to what? We always start off with a risk-free rate, because remember, if you can't earn a risk-free rate, then what are you doing in the market? Get out. Okay, so this is not an investment that you want to be in if you can't earn the risk-free rate. If you can't earn the risk-free rate, rather go and invest in a US Treasury, at which you will earn yourself the risk-free rate. Then we say to ourselves, okay, then I want you to go and plus risk premium 1, plus risk premium 2, etc., etc. And of course, there's a little bit of an error term, which we're going to assume to be 0 for the most part. Okay, at the back end of the formula. What is each of these risk premiums? Each of these risk premiums is equal to this factor sensitivity, or the beta, times by the premium attached to that. Okay, so remember, the risk premium, as we contain them over here, is really just the factor sensitivity, or beta, times by the factor risk premium. If I was in CAPM, what would my factor risk premium be? Well, it would be what? It would be my equity risk premium, which is what? The market, return on the market less the risk-free rate. That would be my risk premium term, number 1, for CAPM. And you would go and work out your risk premium 2. And because it's a multi-factor model, you can keep on adding and adding as many as you like. We'll talk about it if you can do that. In fact, can you keep on adding? And the more that you add, does it in fact, you guys remember this very well, of course, from Chi Level 1, topic 2, the intro there, does it in fact add any more explainability to the R, which is my expected return, the more I add on to my equations. We'll talk about that. The multi-factor model's got certain assumptions. Okay, it describes the returns on the asset. That's your R, of course. Okay, due to the large number of assets, okay, the investor can diversify his risk and eliminate specific risk. Remember what we call the fancy term for specific risk, guys? I'm sure you all remember. I'm not going to embarrass myself and try and spell it. I'll just give you the bits. Idiosyncratic risk. Okay, and that's specific risk. Specific, or another word for it is unsystematic risk. And remember that was the same thing that the CAPM did. Okay, that was the same point of the CAPM. Okay, and number 3, we are dealing with diversified portfolios. No arbitrage opportunities exist. Okay, good. A little bit over here, we look at ex-ante and ex-post models. Okay, I wouldn't spend a lot of time over here, just get a sense of these. Okay, I'll explain to you what the difference between the two are. Ex-ante, remember, ante is always forward-looking. It's what we expect, and it's because what we expect, therefore I say, what is my ER? ER is what's my expected return. Well, my expected return is expected this, expected that. Same thing, but just I'm using the terms expected. I don't have the answer yet because it's a forward-looking model. When I then move across to the ex-post, post means, okay, past, historical. I do exactly the same thing, and I say to myself, RI, as opposed to expected return, RI is the return on the investment because it's the actual return. That's past, okay, and I use my factor sensitivities and my factor risk premiums. A little bit of a difference over there, of course, between ex-ante and ex-post. I wouldn't focus overly on that as we go through then. Okay. Okay, the role of marginal investor utility in the CAPM and how it relates to asset factors. Okay, as we know, guys, the CAPM works with a single factor, that being the market return. Okay, investors, very important, just a little bit of theory over here, guys, they derive higher marginal utility, okay, during bad times, because of course, you know, to earn returns in bad times is much more beneficial to people than earning returns in good times. Okay, so your payoffs in bad times are more valuable because that's when people are battling. That's when returns are very low. If you can get good returns in that time, okay, then and the rest of the market is generating negative returns, then of course those are very valuable. That's all very valuable or high levels of marginal investor utility. Okay, by way of example, we look over here, guys. Okay. Assets whose returns have got a high negative correlation with consumption demand, with consumption. Okay, in other words, they work the other way around. They demand a low risk premium. On the other hand, if they've got a high level of correlation with consumption, okay, not very useful when things become bad, because when things become bad, consumption is impacted, and if there's a high level of correlation, they both get impacted in the same way, in a negative way, of course. Okay, if you now want people to hold these particular investments that are not doing so well when times are bad, okay, they're going to demand a high risk premium to do so. Okay, they're not the flavor of the month because they are they got a high level of correlation, a positive correlation with consumption. Consumption is currently very poor due to the bad times. You don't want to be holding these investments. If you want people to hold these investments, well, then you better pay them a high risk premium to do so. Okay. You move on a little bit more theory for you guys. How multiple factors relate to bad times. Okay, similar concept, guys. Okay, when working in a multi-factor model, okay, obviously there's a difference now, because remember, each investor in a multi-factor model, the factors that you're dealing with now in a multi-factor model don't impact everybody in the same way. Unlike, of course, the CAPM, where it's just really one factor, which is the market factor, which tends to impact people quite similarly. We look by way of example over here. Okay, investors who have human capital linked to their jobs, okay, that suffer during periods of high inflation. Okay, what kind of investments would these people prefer? They would prefer investments or factor exposures, we call them, exposures to various factors, okay, that will cause their assets to do well during periods of high inflation. Okay, because remember, they themselves, okay, have got a job that will do poorly during periods of high inflation. So they themselves are going to do poorly during high inflation. They want investments that will then do well during the same types of periods. That's what we call how multi-factors relate to bad times. You obviously want, and probably what we would call, it's not written out so explicitly over here, okay, we would probably be looking for negative correlations in such respects. We're going to see a very similar concept, guys, something very exciting coming up for us. It's all exciting and it's all lovely, of course, but when we hit topic number 3, which is coming up next week, okay, institutional asset owners, we talk about a thing over there, guys. It'll be chapter 13, pension fund portfolio management. Now, when we look at pension funds portfolio management, one of the concepts that we talk about there, which is quite important, okay, we'll just give you a bit of an intro to it because it's some nice stuff. That, for example, here is the what we call the sponsor of the pension fund. Okay. Now, the sponsor of the pension fund is the company that is responsible to pay out the pension benefits when they become due and payable. Now, what we say over here, because remember the sponsor is then responsible to make payments to all the, what we call the beneficiaries. Okay. Now, a key concept that we say is we don't want the sponsor, okay, who is responsible to the beneficiaries, okay, to be investing in its own company. Okay, and one of the reasons we say that, of course, is because this sponsor is responsible, let's say, for example, in 10 years' time, to make payments to all the beneficiaries. Now, if the company doesn't do so well, well, then there's a double bit of a whammy. The company's doing poorly, and the investments that this particular sponsor has invested in to make sure they can pay beneficiaries is the same company that's doing poorly. So we always want a bit of a negative correlation as well over there. We tell this sponsor who is responsible for the payments to beneficiaries or payments to the pension people to invest in a company that is not related to themselves or to their company. Go look elsewhere for your investments. Don't put all your eggs in one basket, because if bad times come, you're going to get hit very hard. But we'll see all of that when we get to chapter 13. Just some nice, exciting stuff ahead of us. Okay. We talk about factors based on expected utility or anomalies. Okay. Factors are driven by influences that are linked to expected utility or anomalies. Okay. Expected utility maximization. That's, of course, what people are looking for. They want to maximize their utility. Okay. And we say that any factor premiums that can't be explained by people maximizing utility, okay, we call those anomalies, because they should be able to be explained away by the factor premiums. Okay. And in summary, guys, a risk premium related to a factor not explained by normal utility models or risk aversion is called an anomaly, because typically speaking, factors or risk premiums should be able to be explained by utility. In other words, a person expects more utility. Well, if you expect more utility, well, then you must pay a risk premium for that. If we can't explain additional utility that is gained by investors by way of risk premiums related to that factor, that's what we call an anomaly, because it should be explained. It should be able to be explained. Okay, we move on. 3 major categories of factors. We talk about macro factors or macroeconomic factors. Okay. Some key factors that obviously will drive macroeconomic factors are things like productivity, inflation, credit, economic growth, liquidity. These factors drive asset returns across an entire economy. That's why they're called macro factors, macroeconomic factors. Fundamental style number 2, investment or dynamic factors. These are generally linked to fundamental firm attributes. Okay, they drive asset returns across various assets. Factors that are included are value, size, momentum, volatility. All these good kind of things are things that will drive, are fundamental factors that will drive returns across asset classes. Number 3, statistical factors. Okay, for example, things that they also work across the entire economy, asset classes, etc. Okay, and these, why do we call them statistical factors? Because they are generally based on empirical. Empirical, guys, means they've been tested, experimented on, and proved to work. Okay, it's not a style. It's not an economic characteristics. It's whatever you've looked at the past and that has worked in the past. Okay, things like principal components analysis, which we call a PCA. Okay, and the PCA it says, well, what are the key components that have driven investment returns in the past, whatever they happen to be. One might well be value, one might well be style, but one might also be a good culture in the firm. That's driven returns, whatever it happens to be. But statistical factors look at the empirical, how it's worked in the past, and try and use that as what will drive returns going forward. Okay. We talk about theoretical versus empirical models, guys. I'm boring you to tears because you've heard about this before. Okay. And we talk about how are risk factors derived. Now, when we talk about how risk factors derived, let's start off over here. So I'm an asset manager, and of course I want alpha. Everybody wants alpha. Okay. Not everyone can get alpha, but everyone wants alpha. So I say to me, okay, what is my return? Some people, and remember, if I'm working ex ante, which I probably am, ex ante is a future look, so I would say ER, expected return. You can write it how you like, it's not necessarily that important. So I'm looking for ER, I'm looking for what my expected return is. Let's start. So straight away, I want at least the risk-free rate, because if I can't get the risk-free rate, I might as well go home. Okay, and then just open up myself a little risk-free fund and either put the money into money market, which is relatively risk-free, or put it into US Treasuries, which is equally risk-free. Okay, but I've got a batch of clients that's not happy with that. Of course, they don't want the risk-free rate. They can do that themselves. What do they need me for? They want me for beta. Not beta, sorry, alpha. So let's try and see if we can't seek alpha. So I start off and I say, okay, my expected return is risk-free plus. Okay. Now, I'm going to try through various means. And what are my various means? I'll take you back a page. My various means are, well, I can use macro factors, fundamental factors, statistical factors, anything like that to try and see what will get me my most amount of alpha. So then I start off and I think to myself, okay, well, let's see, maybe if I invest in, say, value companies, that might do it. Okay, so that's one factor that I could use. We'll test that, see if that works. So let's see, maybe I can also use I don't know, think of something else, a volatility factor. Maybe that'll drive my returns. Let's try to have a look at that one. We'll test it and we'll see. And away we go. Okay. Now, we're not talking about trying to derive returns. Okay. If I'm doing it based on theoretical models, I can either do it based on that or based on empirical observations. Okay. Theoretical, guys, we've seen this before. They make assumptions. Okay. That look to capture investment behavior. Okay, what might work theoretically? What's a good model? Empirical says, well, what worked in the past? It worked in the past. Okay, past observed investment behavior. Let's see if that will work. So theoretical is what should work based on various assumptions. Okay, and empirical is okay. Let's try and use what happened in the past and has worked in the past. Okay. Some of the concerns over here, guys, of course, because we know after all of that, okay, by the way, we are doing alternative investments. We haven't spoken too much about alternatives thus far, but let's jump straight back into that as a concept again, guys. Okay. And generally speaking, empirical models are more appropriate. Now, why are empirical models, in other words, models, okay, that use past observed investment behavior, why are they more appropriate? Because remember, alternative investments are very difficult to categorize based on theoretical models, because some of the factors that alternatives, you remember this well from level 1, we've got factors like illiquidity, non-normality, frictions, etc., okay, which might work nicely with a normal distribution with traditional assets like equities and fixed income. Does not work, of course, as well for alternative investments. Okay, one of the things, of course, we've got to be mindful of, guys, and this is just an important concept, but we've seen this before as well in level 1, spurious correlations. Okay, when looking at historical data. So yes, empirical is a lovely concept, but I've also got to be mindful that perhaps that my empirical observation has proven to be has resulted in what we call a spurious correlation. Let's say, for example, I come out and I say, okay, well, let's go and see, I'm going to go and test various things from the past, and I'm going to go and see if there's a correlation or there's a link. And what I go to Singapore. I spend a bit of time down in Singapore. Okay, apparently it's a lovely, lovely country. Okay, haven't been there yet, but hopefully one day. And I go and I do some research on Singapore. And what I notice that every single time that it rains in Singapore, the stock market goes up. And I'm thinking, wow, have I just identified the most important factor that is driving equity returns? It's rain. Amazing. Every time it rains in Singapore, okay, the stock market goes up. And I say, wow, that is the most fantastic correlation. What a factor. What a factor. So now how do I derive benefit from this factor? Well, then I go and I pull some anti or future looking. I know in South Africa they seldom write. I don't know about in the rest of the world. Weather reports. And I say, okay, well, it's going to rain on Tuesday. Oh, I better get into the market late Monday afternoon, just before the rains come in Tuesday, and I'll be able to earn some fantastic returns. And I test this back for 5 years, and there's a 90% correlation. This is fantastic news. Okay, there's a 90% correlation between rain and equity returns on the Singapore market. Fantastic. Okay. I then ask myself, I then move to the next step and I say, well, what kind of a correlation is this? And I'm probably going to call it a spurious correlation, a nonsense correlation. It might well have proven empirically when I did the testing, yes, it worked. And every time it rained, the markets went up, and there's a 90% correlation. Wow, 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 fantastic, which seems to say that's a very high level of explainability, blah, 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 all what you're familiar with, guys, from Chi Level 1. However, it's spurious, it's nonsense. There's no reason, rhyme or reason why rain that I could think of, okay, should lead to increased returns on the stock market. No reason. Okay, no logical reason. And that's, of course, guys, when we do find some kind of a factor that might work based on empirical, which is what we should be using for alternative investments, just make sure that the links are not spurious, okay, and just coincidental. And because in truth, guys, there is no relationship in truth that exists between the rain and the upward moving stock markets. Just be careful of that one. Okay, we move on. The following steps are used to derive a multi-factor model. Determine the excess returns on the investment. Okay, what's the excess return? The excess return is the actual asset return less the risk-free rate. That's a little bit that's what you're trying to earn. Okay, how much is it? Okay, we would call that the dependent variable in my regression. And what is it dependent on? It's dependent on many other factors. So step 2 is then I want to say, what are those other factors causing my dependent variable, my excess return to be there? Okay, and I'll try and find myself some of those, and then I'll test if they are significant. Guys, we know all of these tests. Remember them well, things like hypothesis testing, things like that, coming through from Chi Level 1. Okay. We talk about tradability, tradable versus non-tradable. Okay, a tradable asset is a position that can be established. Of course, it's tradable and liquidated in a financial market. Non-tradable variables are things like inflation, factors like inflation, economic productivity. Quite difficult to trade them as a specific position. Okay, all right, we move ahead. Okay. The tradability of factors, one of the key characteristics of using tradable assets in my pricing models, okay, that if the factors that I'm using, okay, are in fact tradable, okay, and if the model that I'm using, it contains all the potential systematic return factors, okay, then the intercept of my model, which is my mean, okay, can be interpreted as the superior or inferior risk-adjusted return of that asset. Okay, good. And this is typically what we do over here, guys, of course. Okay, assuming that all my systematic return factors were included, I got everything there, I managed to include everything that should be, plus they were all tradable, these factors. The idiosyncratic or unsystematic error term would be 0, which is most of the time exactly what we are assuming. Okay, and guys, that was a little bit of the theory. 8.1 was a bit of the theory behind what we're doing. Okay, not that it's unimportant, but just quite theoretical, of course. We move forward to learning objective 8.2. Now we go into the various models. Okay, and what we look at over here, 3 separate models: Farmer French original model, the Carhart model, and models with numerous factors, which in fact is Farmer French extended. I'm sure you all know, guys, the Farmer French is a 3-factor model. The extended Farmer French is now a 5-factor model. Okay, and we need to discuss, of course, guys, if it's a 3-factor model, okay, and those 3 factors were working very nicely in terms of being able to, those factors were able to explain returns, why then did we need to seek out additional factors to explain returns? We'll get to that as we move through the notes. Let's go. Farmer French original model. Okay, 3 factors over there, guys. I'm not going to spend too much time over here. I'm sure guys are very familiar with Farmer French. Okay, the 3 factors. Well, the first factor is exactly the same as the CAPM model. That's the market factor. Okay, then we've got the size factor, and according to Farmer French, we work with this thing called SMB. SMB is small minus big. In other words, which companies are expected to outperform others? Small caps are expected to outperform large caps. That's what we call the size factor. We move along. Okay, value factor is HML. HML is high minus low. High what? High, okay, high value companies are expected to outperform low value companies. What are low value companies, as are called? Growth companies. And how do you determine what is a high or a low? Well, you look at this ratio called book value over share price. Book value over, okay, share price or market value, call it whatever you like. Now, a value company will have, for example, a book value of 100 over its share price of maybe, let's make it 150. Okay, that's quite a high ratio. Okay, when we move across to a growth company and look at their book value over their share price, you're looking probably at the book value. Remember, growth company, look at a company like WhatsApp or Facebook. The book value, the physical book values are very, very little. Okay, because what do they have? They probably have some servers, a few buildings or anything like that, but not a massive amount of physical assets. We make that 10 over their share price, which is massive. Let's make that about 1,000. And you can see that ratio is very, very low. Okay, so when you talk about high minus low, remember how we calculate that is the use of book value per share over share price. Okay, and who does Farmer French favor? They favor the value companies which have got very, very, okay, high, that's why it's called high book values over share price. Here's your formula, guys. Okay, what's your expected return? It's risk-free, of course, that's always the starting point. Beta of the market times the market factor, guys. If we had to stop over there, that would just be CAPM, am I right? Okay, but of course Farmer French is a 3-factor model. It takes into account size over there as well, and also takes into account value factors as well. And who do they favor? They favor small, and they favor value companies. Okay, good. Okay. And there's a little example, guys. I'm not going to spend too much time on it with you. I just want to point one thing out to you, okay, as we go through it, is don't be alarmed if you get a question on a multi-factor model, okay, and one of the factor sensitivities is negative. Okay, all that means is that it's a negative sensitivity. Okay, your particular business is negatively sensitive to size, that's all. positively sensitive to the market factor. Okay, so don't assume that there's an error or anything like that. Just plug and play as you go through your question. If it's a minus, of course, you'll use a minus, like over there, minus 130. You can see we just plug in a minus. Okay, and that's all that you need to do with that. Okay, really, guys, this is just a plug and play question. So it's going to be 4%, which is your risk-free rate. I picked it up over there. And it's all of the factor sensitivities, the betas, beta coefficient times by the risk premiums. I get your required return of 6.61%. Okay, we move forward. Comes the next model. Okay, that is your first model, okay, which is your Farmer French model, original Farmer French, we could call it. We then move across to what we call the Carhart model, and the Carhart model is an extension of Farmer French with one more factor. So in fact, what we would call the Carhart model is a four-factor model. And what additional factor has been introduced? We've introduced that of the momentum factor. Okay, so everything is the same as what we saw for Farmer French. A new factor called momentum. Okay, and what do we say about momentum? Momentum, okay, is UMD, up minus down. In other words, what am I hoping for momentum? What do I favor? I favor up momentum. I'm happy when stocks are moving upwards. Okay, what don't I like? I don't like downward momentum. Okay, when stocks are moving downwards. That's it, and that is the whole of the Carhart model. Nothing more, much more to add than that. Came across our new model, which we call Farmer French new model or extended model, call it whatever you wish. Okay, they came across and they found in 2015. You don't need to know that date, of course. Okay, that the HML, okay, the value factor. Remember, HML is high minus low. It wasn't working so well in terms of its explainability as a factor. Okay, there's various reasons why it wasn't working perhaps as well, why it's becoming a little bit less explainable. Because remember, of course, guys, factors are not static. Okay, and over time the factors will become either perhaps less or more explainable. You know, the market may start to take advantage of that particular position, which of course eats into the profitability of the strategy. So they don't last forever. You know, you can't design yourself a factor model and then sit back and say, well, this is going to work forever. As you can see, even Farmer French, which is one of the most famous models, decided that HML or value, the value proposition, was not working as well. They added two more factors. Okay, RMW, robust minus weak, and robust or weak what? Operating profitability. So, and who do they favor? They favored robust companies with robust or very strong operating profitability as opposed to those with weak operating profitability. That was the one thing they added. That's over there. They also added in CMA, which is conservative, okay, less aggressive. Okay, and they favored companies that invested conservatively as opposed to companies that invested a little bit perhaps too aggressively. Okay, keep in mind, of course, when we say that Farmer French moved away a little bit from the value proposition, they kept that in their formula. Okay, so that didn't go completely. It's still there, but it's now become a 5-factor model. There we go. And guys, of course, I put those all in for you. You know me by now. No one's going to be studying those off by heart, of course. We're going to just use our intuition and our ability to dissect stuff as opposed to learning stuff too much off by heart. Okay. Top of page 8, learning objective 8.3, knowledge of the 3 challenges, guys, of what? And you read the words carefully. Empirical models, empirical multi-factor models. Okay. Empirical is what? Okay. Empirical is looking at what happened in the past and trying to use that to explain what might well happen going forward. Okay, now we have a look over here. Okay, when you are trying to say test a certain amount of variables, let's say for example in my case 300 variables in my example over here, and I'm using a confidence level of 99. Okay, what does that mean? Well, if remember, guys, from level 1, confidence level and level of significance are just two sides of the coin. So if I've got a confidence level of 99, I've got a level of significance which is equal then to 1%. Okay, if I then take my level of significance of 1 times by 300, which is my total amount of variables that I'm testing, what's going to come out is that there's going to be 3 variables, okay, that will come out, will show themselves to be statistically significant, which of course means that they say, yes, you can rely on us to be able to explain away asset returns. We'll help you, says these 3 variables, but in truth they are even though they're showing themselves to be statistically significant, there is no underlying relationship. That's the 1%. So remember, it's not always going to be completely spot on, of course, and the reason for that is because we are not working with 100% level of confidence. We can't, of course, because that's a sample, but we're working with a 99, 95 or something like that. So factors may well show themselves up to be statistically significant or explainable factors, but that's in fact that's incorrect. Okay, good. Factor correlation versus causation. Remember, guys, very important to remember. Okay, that there's a big difference between correlation and causation. Things may well correlate with each other. Okay, they may show they may show themselves up to have quite a high level of correlation, but then in fact there's no link, there's no causation. One does not cause the other in any way. They may have a high level of correlation with each other, but it may well mean, but it doesn't have to mean that there is causation as well. Okay, last point over here, guys, why the CAPM may not be sufficient. Okay, when using an empirical multi-factor model, does this, in fact, when I add more factors to my model, does that perform better than CAPM? Okay, in describing risk and return trade-offs? Okay, in other words, why would I need a multi-factor model? Why would I need more models, more factors, when I could just use CAPM, which is a single-factor model, which might well just explain all my risks and returns? Okay. Good. And some of the reasons that we bring over here, guys, not to use the CAPM, which is a single factor model, okay, the CAPM's inability to capture all the relevant variation. Remember, it's just CAPM works with the mean and the variance. Mean is the average, okay, or the return, and the variance is your risk. But remember, the minute we move towards things, particularly for us guys in alternatives, mean and variance, or the first 2 moments within a statistical picture, are not necessarily all that I need. I need to look at the other higher moments as well, things like kurtosis, okay, skewness, and all good things like that as well. Number 2, multi-factor models capture investor-specific differences. Okay, we use the word heterogeneous. Okay. Remember, the CAPM doesn't do. The CAPM works with a single factor called the market. That's all that it works with. Multi-factor models can work with everybody. Okay, it would depend on what factor you're interested in. And number 3, of course, okay, alternative investors, okay, cannot necessarily only work with the CAPM, which is the market. Remember, because they invest in alternative assets, a lot of which are privately held. Okay, we move on a little bit over here, over to the next page, learning objective 8.4. Okay, we talk about factor investing. Okay, we'll look at the various factors as we go through over here, guys. Okay, factor theory focuses on assets. Okay, doesn't look at assets specifically, but it looks at a bundle. What is an asset? Well, that asset is not an asset anymore. That asset is in fact just a whole group of factors. Okay, examples of factors include a market factor, an interest rate factor, inflation, economic growth, investment styles, etc., etc. So when you look at a business, an asset, you're no longer looking at a business anymore. Okay, you're just looking at, well, that business in terms of factor theory, okay, is really just a bundle of different factors or risks. Okay, for example, if you look at certain companies, they may be quite heavily, for example, a bank, one of the key risks in a bank might be interest rates. When you look at an industrial company, interest rates are much less sensitive. That's not a massive factor in that particular asset called industrial company. Whereas if you look at a company called bank, yes, interest rate is a major factor, risk factor involved there. So if you're looking to get involved in factors called interest rates, well, then you better stick in the banks, okay, as your key areas of investment, etc., etc. The following three principles form the basis of factor theory. The key are factors, not assets. So I'm not looking at any kind of, I don't care what assets I'm investing in. I'm looking through the asset to see what particular factors drive the asset returns. Okay, number two, every asset represents a bundle of factors. Number three, every investor's got their own optimal risk exposure. Okay, different investors will want different factors and different risks and different exposures. Okay, how return factors are described. I'm not going to spend too much time over here. We have looked at these already, guys. I'm just giving you a little bit of a washing list over here. Okay, some of the better known factors, of course. Okay. Just remember the better known factors may have been a little bit overused in the market and may not be describing returns as well as they did perhaps in the past. Market factor, that's CAPM. We've dealt with that in great detail, okay, over our page. The size, okay, remember what we said about size in the Farmer French SMB, small minus big. Small caps tend to outperform large caps according to the size effect. The value growth effect we spoke about, HML, high minus low. High what, guys? High book to market value ratios. We've spoken about that in great detail. Momentum effect, what do we say about momentum effect? Up minus, okay, down. This is of course what Carhart introduced to us. Okay, you've got the yield effect, the dividend yield. High dividend yields tend to provide excess returns in low interest rate environments. That's the yield effect. The quality effect. Okay, how do we define quality? Okay, stocks with consistent earnings and dividend growth will do better. Volatility effect. We look at volatility as a factor and how that will drive returns. Okay, remember the two additional parts. If I just take you back, other factors, I'm going to just take you back a little bit over here. Remember, the new Farmer French has some more factors for you: robust minus weak and conservative minus aggressive. You could add those in as factors as well as Farmer French has done. Big data. Okay, what is big data as a factor? Okay, big data as a factor. Okay, also called all the different kinds of data that can be generated. Okay, as a factor as well. Okay, and guys, as you can see, I've given you some of the more commonly used factors, but again, factors can be anything. If you can, and remember, you would probably be using an empirical model, in other words, looking back and testing the factors to see how this factor performed in the past to try and drive returns going forward. Okay, top of page 11, how risk premiums vary across return factors. Okay, remember there's going to be different risk premiums, and the size of these premiums are not constant through time. Remember, as time goes on, as circumstances change, the risk premium and the size of the premiums will differ. Okay, point number 2 on page 11, how factor returns vary across market conditions. Okay, factors will behave differently in different market conditions. Okay. Depending on what that market is doing. We talk about this concept, guys, and I always tell you guys, remember, as soon as you see a nice term like this, a momentum crash or something like that, I always advise you just to perk up a little bit and put a bit of focus on that, because that is something that my sense is always going to be something that is quite examinable. Okay, a momentum crash, okay, is when those assets that have recently overperformed, they've done well. The momentum for them was upwards. Upwards momentum, guys, remember, nothing ever lasts forever. Okay, now they start to experience poor performance relative to similar assets. Okay, and based on this, we say just as it is advisable to hold diversified portfolios, okay, in terms of many different asset classes, okay, That's a famous principle of modern portfolio theory from Markowitz. Okay, the same principle, of course, will apply. It's advisable to hold diversified portfolios in terms of factors as well. So if you want a diversified portfolio and you are a factor investor, don't only go and invest in companies with interest rate factors or volatility factors. Diversify your factors in terms of your portfolio as well. Okay, the relationship between factors and investability. Can factors in fact be traded? Okay, and more as the market grows, of course, and various vehicles are trading vehicles are available. Okay, with specific reference, of course, to derivative instruments. Okay, and exchange traded funds, ETFs. Okay, a lot of the stuff has become very, very tradable. Volatility is now tradable. I'm sure you guys know. We haven't put that over here, guys. A volatility index. What's the key volatility index? That's of course called the VIX. Okay. The Farmer French model has become very tradable. All the various factors in that model are quite tradable factors. Okay. And away we go. Okay. We look over here, guys. Risk allocation based on return factors. Okay. Very important to remember that factor or risk allocation is no different to how we traditionally allocate assets. Because remember, okay, you need to. How do you invest in assets? Well, you invest in it's not in assets, in factors. How do you invest in factors? Well, you've got to identify certain assets, okay, that contain those particular factors that you're looking for. Okay. Two issues that relate to factor investing. Number one, we cannot create a benchmark for passive factor investing. Okay, because remember, factors involve long and short strategies, and we're never really 100% sure. There's no clarity what the weighting in what a factor weighting should be in a diversified portfolio. We don't know that, because remember, those are going to keep changing, and different investors have all got different expectations surrounding factors. Okay. Number two, what we need to be aware of, guys, is direct factor investing requires an investor to actively manage portfolios that represent these assets. Remember, okay, you can't passively manage factor portfolios. There's no real thing. You need to actively manage certain assets, and these assets then contain those factors that you are looking for. Okay. Over our page, performance with allocations based on factor return factors. And the obvious question that everybody's been waiting for, I'm sure, okay, is do portfolios, okay, that have been allocated to based on factors outperform portfolios that were allocated based upon asset classes and not factors? Okay, in a perfect world, assuming all factors are tradable and all asset returns are explainable by factors, well then neither approach, not a factor approach nor an asset-based approach, should generate superior returns over an extended period of time. Okay, certain practical issues, of course, that we just need to highlight over here. Okay, portfolio construction using returns is not globally adopted. Generally, this concept of factor investing is not generally globally adopted just yet. Okay, and some of the reasons for that, okay, is that allocation strategies are not always going to be sustainable. Okay, for example, things like you need to be short a certain thing. You can't go short that particular factor all the time. Those are certain things that will restrict portfolio construction based on factors. Number two, risk allocation requires owners to take extreme positions in certain classes. Okay, and remember, when that does come about, and you need to start to take these positions, which may not necessarily be regarded as fiduciarily, I don't know if that's even a word, appropriate. Remember that will exclude certain investors, certain institutional investors, from getting involved, because they are not allowed to invest in certain investments that may appear too extreme or too risky. Okay. Number three, alternative investments are important vehicles for accessing certain factors. Okay. Remember again, what did we say? They just represent a bundle of factors. Okay, and of course you can't get purely into those particular investments in any meaningful manner just to invest particularly in those factors. Okay, that's point number 3. We move on a little bit. We talk about this fancy concept called the AMH, the Adaptive Market Hypotheses. Okay, and what that it's a lovely theory, and what it comes along and tells us, okay, is exactly adaptive. Okay, adaptive means it starts to apply the principles of evolution to the markets. It says markets, are affected by competition, and how adaptable the participants of the market are to the competition. Okay, we talk about principles called natural selection and evolution. Okay, and those participants in the market, if they are not able to compete and adapt, they will not survive. Okay, arbitrage is possible. Okay, and any particular investment strategy will not consistently do well, as we've said many times before, but will sometimes have great performance, periods of superior performance, and then periods of inferior performance. Okay, what are the implications of this particular model called the AMH, the Adaptive Market Hypotheses? Okay, the relationship between risk and return changes over time, and of course then so does the risk premium. Nothing remains constant. Arbitrage is present in the market, and those that are able to will take advantage of it. Number 3, no particular strategy will work all the time. And if you want to survive in the market, you're going to need to adapt. So the key objective of the adaptive market hypotheses is called survival. Okay. Over our page over here, learning objective 8.6, we talk about volatility and time varying volatility. Okay. First one, predictability of equity market volatility. Generally speaking, equity market volatility is somewhat predictable. Okay. Talking about the theory of informational efficiency, we can generally predict what is going to happen in the markets. Okay. Good. Okay. And that's equity market volatility. Equity markets should be and generally are more volatile when we talk about certain informational events, when information is going to be released to the market. I'm sure you guys are all aware of the extreme amount of volatility that the US markets have experienced recently as a result of the US election. Okay, and this equity market volatility, okay, can be predicted to some extent, okay, with general technical analysis models. And of course, guys, you remember from Car Level 1, to try and predict the volatility, sometimes one would need more complicated models. Those are the Arch and the Garch models as well. In other words, what they try and do, these models, they try and predict future volatility based on past volatility. Okay, how volatility is negatively correlated with average returns. Okay, generally, equity market volatility has got a high level of correlation with the market's direction. There's increased volatility during negative market returns. Okay, that's number 1. And low levels of volatility during positive market returns. Okay. Time varying volatility and using multiple factors. Okay. 2 approaches that we're going to use over here, guys. I wouldn't spend a lot of time on this. We talk about the Heston and the Bates model. The Heston model, okay, allows volatility of the asset to change through time in a continuous process, but they revert back to the long-term average or mean. I'm going to just try my luck over here, guys. If I take you all the way back to interest rate models, which was the key model that also spoke about reversion to the mean. Okay, and I'm sure you guys all remember it well. It was the Vasicek model. Okay, and guys, that's where I want us to be able to look at some of the models and to be able to get a good sense of where everything fits in. The Bates model treats volatility as a stochastic, a moving process. Okay, but not just that it moves around, but it includes a jump process. Okay, that there are random times, random intervals, that the price jumps upwards and downwards. Okay, and how much random magnitude as well. Okay, and that's quite important for us, guys, because we know that that's what equities do. Equity prices move up and down at quite random, and there are these things called jumps, price jumps, which obviously affect the market. Okay, what about higher moments? Time varying volatility with higher moments. Remember, when we talk about the general moments, we talk about the mean. That's the first, and the second one is the variance. When we move to higher moments, we're typically talking about kurtosis and skewness. Okay, good. And of course, we know when we're talking about time varying volatility, the distribution of assets returns is not normally distributed. There's not a normal distribution pattern. Okay. Generally, skewness has been associated with higher risk premiums, particularly negative skewness. Okay. Which is extreme events. Negative skewness is always typically evidence of that there is some extreme event going on. Okay. There we go. Okay.